Hello everyone and welcome back to Fun with Fitzy. Today's video is chapter 10, video 6. We are going to be looking at the amortization of natural resources. Okay, so let's talk about what natural resources are. As you can imagine, these are things that are naturally occurring in the world that companies use as resources in their business. They consist of timber, like trees and forests, for the whole timber industry, pulp and paper, stuff like that. They're underground deposits of oil, gas, and minerals. These could be mines, diamonds, gold, you name it. And of course, oil and gas. These natural resources in accounting are frequently called wasting assets. That's because they are physically extracted in operations and they are only replaceable by an act of nature, which means the trees have to grow back, stuff like that. When calculating the amortization for natural resources, we're going to use the units of activity method. And we like to use the units of activity method because when you're cutting down trees or extracting minerals, we can count the number of trees or determine the amount of minerals that we've extracted and sold from our mine. So we like to use the units of activity method here. Okay, although we're going to use the units of activity method when we're doing amortization for natural resources, there is another factor that we need to consider, and it's called a liability for restoration. And as we know, liability means we owe money. And this liability is referred to as an environmental liability for restoration. This is a financial obligation that a company incurs for the costs associated with restoring the property or natural resource to its original or predetermined condition. It typically arises in situations where a company engages in activities that may result in environmental damage or disruption, and there is a legal or regulatory requirement to restore the affected area to its previous state. So there's many situations that companies have to have this liability for restoration. It could be environmental remediation, and that's like for companies involved in activities like mining, oil and gas extraction, stuff like that. There is land development. So developers are responsible for restoring or rehabilitating land areas after construction activities are completed. For natural resource extraction, companies involved in those types of activities are obligated to put restoration efforts to ensure the sustainable management of these resources, etc., etc. So this is going to be part of our formula. So there's three things that we need to consider in the journal entry. Normal, when we're doing amortization journal entries, we have our amortization expense and our accumulated amortization. We're used to these two things. However, there's a third account which we're going to credit. So we're going to debit our amortization expense, which we already do. We're going to credit our accumulated amortization, which we already do. And we're also going to credit our liability for restoration because we're going to need to pay that. Now, the whole formula for our amortization expense is very similar to our formula for units of activity. We have cost, so that would be the cost of acquiring the land, let's say, or the mine shaft, or whatever it is. As we know, our residual value is the value that we expect to get for this asset at the end of its useful life. And now we have to add in a cost for restoration, which is also another estimate. We have to estimate how much we're going to have to pay at the end to restore this property back to its normal state, let's say. And all of that divided by the total estimated units that are going to be fully extracted and sold from this property. So that's the formula to get our amortization expense. Now, really, we're going to use the same formula minus the restoration cost. So we're going to have our cost minus our residual value divided by our total estimated units is going to be the formula for our accumulated amortization. And then, of course, just the cost for restoration divided by the total units extracted and sold is the formula for our liability for restoration. So you can do all three of these, which is what I would recommend you do, or you can just do two of them, and then in your journal entry you're going to know what you're missing. And I'm going to show you that in a couple of examples. So again, at the end of our examples, this is our adjusting entry, the amortization expense, what we calculate using the formula that I just previously showed you. And then we're going to credit the accumulated amortization, and we're going to credit our liability for restoration. So let's look at a couple of examples. So in our first example, we have a mining company, a coal mining company. So this mining company purchased a coal mine on February 1st. Let me see if I can get my pencil going here. For $2,800,000. This is our cost. The estimated residual value is $342,000, and this is our residual value, which is this part of our formula. And here's our restoration cost. To restore the site after the coal has been extracted, $50,000 will be required, and it is estimated to currently have 500,000 tons of coal overall. So that's going to be our total estimated units that are going to be extracted and sold. And in the first month, 100,000 tons of coal have been extracted and sold. So this is going to be the number we're going to use to do our adjusting entry. So let's go ahead, and this is our formula here for our amortization expense. So let's calculate our amortization expense first. So we're going to have 2.8 million minus our residual value of $342,000 plus our $50,000 for our restoration expense. And we're going to divide this all by 500,000 tons of coal. Okay, so when we do that math, remember our order of operation. So we're going to do everything in this bracket first, and then we're going to divide that by $500,000. We're going to get a rate of 5.016. In units of activity, we have to multiply the rate we get by the number of units that were used in that year. So in this case, we have 100,000. So in order to finish getting my amortization expense, I'm going to take that 100,000 and multiply it by the 5.016, which is going to give us 501,600. So that is going to be our amortization expense. Now, I'm going to just kind of work on the journal entry over here to the right. So as we know, in our journal, we're going to have at the year end, or in this case, it's March 31st. So we're going to have March 31st. We're going to have amortization expense, and that's going to be 501,600. And then, of course, we have to calculate our accumulated amortization. I'm just going to use short forms here, and our liability for restoration. And we're going to use these two formulas. So this formula is for our accumulated amortization. This was our amortization expense formula. And this is our formula for liability for restoration. So we have our first part. Now, I'm going to take this formula here, cost minus residual value, this one here, and I'm going to do it now. So we've done our first step here. Now, which was this one. Now we're going to do our second, and that'll be our third. So this is how we're going to do it. So number two. So now we have our cost, which is 2.8 million, minus our residual value of 342,000, divided by the $500,000. And again, we're going to times that by the $100,000 that were extracted and sold. And when we do this math, we're going to get 491,600. Okay, so now we can put that in our journal entry here. Now, here's what I suggest you do. You calculate your liability for restoration by using the formula, and you subtract this from this to determine what our credit is that we need to put in here for our journal entry to balance. When we subtract 491,600 from 501,600, we're going to get $10,000. So let's just do our third formula and see if we come up with that $10,000. If we do, chances are you are on the right track. So let me just scroll down a little bit here to make room. I'm going to keep that there on the screen. So again, our last formula is going to be just the $50,000, the liability for restoration cost. Divide that by the $500,000 and multiply that by the $100,000 that they extracted and sold. So once you do the math here, you're going to get $10,000, which you're going to put here. Okay, here's a second example. We have a timber company who purchased a forest on December 1st for $3 million. It is estimated to have 10,000 trees in the forest, and it's going to cost $500,000 to restore. The residual value is $600,000. In that first year, 2,000 trees were cut, and the question is, what will be the adjusting entry if the year end is December 31st? So again, we have our three formulas and we have our journal entry. So let's start our journal entry over here so we could do it at the same time. So we're going to have December 31st is our year end. We're going to have amortization expense. We're going to have accumulated amortization. And I apologize, I'm using a tablet and my writing on this tablet is not great. And we have our liability for restoration. So now we got to calculate these things. Remember, there were the three formulas above. So our first formula, in order to calculate our amortization expense, is cost minus residual value plus liability for restoration divided by the number of expected units or total units, and we're going to multiply that by the number of units extracted and sold. Okay, so let's plop in our variables here. So we have $3 million was our cost minus our residual value, $600,000, plus our cost for restoration, $500,000. We're going to divide this all by the total number of units expected, which is 10,000. And we're going to multiply by the number of units extracted and sold this year, which is right here. 2,000 were cut. Okay. So we're going to have 1,000. So I'm calculating right here that our accumulated, so our amortization expense is $580,000. Okay, good. Let's look at our second formula. This time, actually, let's do the third formula first. So our third formula is just the liability for restoration, or the cost, the restoration cost, divided by total units. We're going to multiply that by the 2,000. Okay, so our liability for restoration is $500,000. Divide that by 10,000, times that by 2,000, and I calculated $100,000. So that's going to go right here in our journal entry. Okay. Now, we could just do the math. We could subtract that $100,000 from the $580,000, which should give us $480,000. Because our credits must equal our debits. So let's go back over here and just do our double check. So you don't have to calculate all three formulas if you're confident, but I like to do it as a check. The other way you can do it is just do all three formulas and then make sure your debits equal your credits. Okay, so our second formula is cost minus residual value divided by total units times by the units extracted and sold. So we're going to have our 3 million minus 600,000 divided by 10,000 times it by 2,000, and we're going to get $480,000. There we go. So we are correct. So as you can see here, just to show you what it looks like on a balance sheet, if we were ever to do this, you're going to have your capital assets. And so here's our coal mine as an example. Less accumulated amortization is still going to give you the net book value. The liability for restoration goes in the liability balance portion of the balance sheet. Anyway, hope that helps, and thanks for watching.